Good evening, everybody. Thank you for logging in. And welcome to DSP Netra webinar podcast, a series designed for investors to gain actionable insights through data. I'm Sahil Kapoor, and today we will discuss the 42nd edition of DSP Netra that we release on 5th of every month. DSP Netra is crafted to help investors navigate the markets by understanding extremities and the risk associated with those extremes. This isn't about predicting the future or forecasting, but about equipping you with data and context that tells you how far or close are we to history when it comes to facts. This edition, which is the December edition, features three key sections. In the first one, we look at US debt situation. US has been on a borrowing spree. We'll talk about that. Second is, why has India outperformed in the past? What does the history tell us and what does it teach us about it? And third is some early signals that we pick up from various data that we watch. By the end of our discussion, you will see how focusing on risk and probabilities can significantly enhance your investment outcomes while reducing unforced errors. So let's dive into the December edition of DSP Netra. There is a Q&A button on your screen. You can, click that button and put your questions. At the end of the session, I'll be happy to take these questions and answer them one by one. So, as I said, there are three key sections in this edition, and we'll first talk about the first section, which is the US federal debt situation or the borrowing spree that the US has been on, and we'll talk about that first. So, as you know, US is one of the most dominant economic forces or countries in the world, and one of the reasons why US has a dominant position in the world is the US dollar. Its ability to borrow and service debt is significantly enhanced by the presence of US dollar as the global reserve currency. You can think about US dollar as the new gold. Earlier in the gold standard, gold was the reserve currency of the world. And after the Bretton Woods system and eventually the Nixon shock, US dollar has become the de facto global reserve currency. There are various views challenging that, whether the role of the dollar is diminishing or it is still dominant. But that is a discussion for the later date. As of today, US dollar continues to be the sole reserve currency of the world, with some challenges creeping up, but nothing significant on the horizon. So, given that background, there is a economic concept called modern monetary theory. According to this concept, it is believed that a nation which has a reserve currency can continue to borrow as much as it wants, because it can repay by printing money. And this is something which is probably on test at this point in time. And when you see the chart on your screen, it says that US federal debt is the epicenter of this cycle's leverage and its likely reversal. So when you go back in history and see that every single economic boom, whether it is a stock market boom or driven by economic boom, that is growth in the main street, you will find that leverage plays a very, very important role. Leverage means borrowing. And when you look at any economy, there are three agents of growth. That means three particular segments which consume and invest. One are the households, which means the citizen and other constituents which contribute to consumption and investments. Second is private businesses, which is a fictional entity which undertake various sorts of business activity. And third is the government. These three entities are broadly the three key pillars of each economy. In every cycle, every boom, and even bust, these three entities, either one of them or two of them, go on a borrowing spree. That means they take a lot of debt, they borrow a lot, and generally driven by that, the boom period will never end. That is usually the case why the borrowing keeps on going up. So when you look at the three lines on the chart, when you see this chart on your screen, you will see that the red line denotes the US household debt. You can see there are cycles in which US household debt was rising rapidly, particularly the period between 2000 to 2008, where you saw the US housing crisis play out in the aftermath. And in the cycle prior to that, you had the US corporate sector or private businesses, borrow significant amount of debt. And it was characterized by invention of products like leverage buyouts and junk bonds in that era. And in the most recent run-up, you can see that the whole and sole responsibility of leverage has been taken up by the US federal government. That means the US government itself is borrowing money, while the US households and businesses have more or less deleveraged since the global financial crisis of 2008. So the only entity which has been borrowing left, right, and center is the US government. And you can see this borrowing shot up significantly post global financial crisis, went sideways for a while, but it has been on a rising spree since COVID struck. And you can see that numbers have declined, largely a function of when growth recovered. But on the whole, it has again started to move up. That means the US government has borrowed a lot of money. So this chart tells you one of the most important uh, pointers. A, there is no doubt that the ability of the United States government to borrow has not diminished. It can continue to borrow money, and the world wants to invest in US, whether it is US equities or even debt. But historically, we've seen all dominant nations which hold the reserve currency, when they continue to borrow significant amount, and they also run a balance of payment deficit, which means that they run a very large trade deficit and even the investment position of the country is negative. Usually, borrowing sums beyond 125 to 135% of GDP. That means running a debt that high could be a source of risk. But our analysis tells us that the risk could be opposite. So as you see that a new administration is going to take shape in US in the next 45 to 60 days, and the sound bites which we are hearing from the new administration talks about reduction of this debt. They are saying that we are now uncomfortable with the amount of debt that we are running and we want to cut it off. Now, the point is that if they cut off this debt, which means that they start reducing their annual fiscal deficit or begin to repay this debt, it will probably cause a lower government expenditure. Whether they do this through efficiency, which is the new department that they are talking about, or by cutting expenditure, in both cases, their ability to spend incrementally higher amounts will be compromised. And as you can see that US has run very, very high fiscal deficit. In the fifth slide of this section, I will talk about that number. But one very clear message from this slide, uh, global economy, global growth is at risk when this fiscal bonanza, which US has been running for a large number of years, reverses. And there are now early signals from policymakers because this is a coffee table decision. This decision is driven by politics plus economics, driven by Treasury desk. And when these decisions are taken, they can have large repercussions. So one very important area to watch is policy making on US fisc. And probably in the next 45 to 60 days, we'll get some signs on where is this going to move. So if the US begins to delever or deleverage, it will have negative ramifications for global growth and for US growth. The second chart also tells you that there are some smoke signals or things which are becoming slightly uncomfortable. As you can see that the lower panel here talks about how US interest payments, the federal interest payment, when the government makes payments on the borrowing that it has done on the accumulated debt, you will see that number has now gone above the payments for defense expenditure. That means the US Treasury is now spending more money in repaying or paying interest on their debt payments than it is spending on defense expenditure. And as you know, that US defense expenditure is the largest in the world. So interest payments has now become a large expense for the US Treasury or the US government. How large is this expense? As we speak, it is about 3.8% of GDP. Last time we had this level going back in the 90s when this number went to this level. But this number was even higher in the 80s, and the likely reason was a very, very high interest rate at that point in time. Interest rate in US had gone up to double digits as high as 15%. This time, even at about 5% or lower Fed funds rate, this number has already reached 3.8% because the debt burden is very, very high. Now, over the next 4 to 8 months, there is a likelihood that this number will go to about 1.2 trillion to 1.7 trillion under two circumstances, two scenarios. You can read these numbers, and this becomes a very, very large number. How large is this number? It will be close to about 12 to 14% of all government budgetary spend in the United States, which is a very large number. And this will probably act on policymakers' mind to how to reduce this number. And one way of reducing this number, A, is to start unwinding their borrowing, or B, to reduce interest rates. And the scenario number two largely could happen if US growth slows down. And scenario number one can happen when US begins to reduce its fiscal burden by reducing debt. In either case, it appears to be a case where a compromise on growth has to be reached, which means that US will have to construct possibly a slowdown or what economists have called a soft landing. But historically, we've seen that these are very, very difficult economic paradigms to shift. And the leverage that we've seen, significant leverage buildup that has happened, historically doesn't really get aligned by simpler things, which means that there are hardly any soft landings. Slide number three talks about how the complexion of investors have changed. And I will tell you why am I talking about this slide. And when you look at this chart, it has three lines. It talks about US households pension entitlements, including IRA and 401k. These are effectively ways to participate in US markets through instruments which are better tax efficient, more tax efficient. Second is through stocks and mutual funds in US, which are less tax efficient versus the 401k or IRA. And you can see very clearly that direct stock exposure in US has gone back to levels which were last seen during the dot-com bubble. Now you can put a number of explainers and ideas of financial inclusion or the advent of internet and therefore a deeper level of understanding, etc. But the moot point is that all these cycles eventually coincide with strong equity returns. That means when equity markets perform, not only MTM effects, but also greed causes more participants to jump into stocks directly. And as you can see that these ratios have now reached levels which historically we have never seen. And second and more important aspect, the total stock holding through all means, whether it is 401k or through mutual funds or direct stocks in US, now exceeds the combined holdings of real estate in the wealth equation in United States. That means people hold more wealth in stocks today than they hold in real estate. In the last 100 years, it has happened only twice. First time it happened during the dot-com bubble, and second time in 2024. So these data points tell you that not only US investors are overexposed to equity, they also are enjoying gains that we have seldom seen in markets, which also tells you that this is an extremity which rarely comes and maybe a cause of concern for contrarian investors. The third, as I said earlier, important point in this aspect is the complexion of why has this happened. So this is a global comparison of countries running their fiscal deficit numbers. You can see 2019, we put numbers here, which shows you the fiscal deficit or budget balance that these countries were running, all these countries, including India, prior to COVID. And then COVID happened, you can see fiscal deficit expanded. For example, for India, it went from about 4% to 7% at the peak. For United States, it went from 4.7 to about 10.5. You can see every single country in the world almost runs a fiscal deficit which is higher than what it was prior to COVID. Now, this fiscal bazooka or amount of government expenditure has directly supported growth. Although in most countries, post-COVID effects have waned and economies have now more or less stabilized from the COVID shock, but the fiscal deficit numbers have not reverted, where governments are slow to revert back to their pre-COVID fiscal numbers. And one of the chief reasons for doing that is that the 1,000 pound gorilla in the house, which is United States, which is the most important dominant force of borrowing, continues to borrow as if it is in a war-like scenario. It runs fiscal deficit of close to 6%. And this borrowing, this high fiscal deficit has allowed other countries to continue to borrow at an exceedingly high pace. Think about this, that if prior to COVID, in India, if policymakers had announced a fiscal deficit of 5.6 or 6% or 5%, it would have caused large deviations in currency markets, wild swings in stocks. But as we speak today, all of us sitting here, there is not even a single soundbite around how high this fiscal number is. And the likely reason is that United States is also running a very high fiscal deficit, and so are all the other countries, which allows you to not face very high currency concerns or outflows until United States continues to run this kind of fiscal deficit. And this is where we spoke about in the slide number one, that if this U-turn or reversal happens from United States, which where it says that now I don't want to run 6% deficit, let me go back to 3% or 3.5% deficit. Most other countries will also have to follow suit, thereby cutting government expenditure and possibly impacting growth, not only domestic growth, but global growth as well. And these early signals will start to appear in numbers, in hard data over the next 45 to 60 days, whether they are going to take place or not. Therefore, I think it is a important ingredient to understand these numbers and also keenly watch out for announcement regarding these numbers. As a side point, there is a global concern about United States dollar, which means that more or less a consensus that with such high fiscal deficit numbers and very high trade deficit numbers, it is very likely that when Fed cuts interest rates, US dollar is going to depreciate. And that will allow emerging markets and other non or dollar denominated assets to continue to do well. Now, we believe that most other countries are running fiscal policies which are even worse than what United States is running, and therefore it gives some sort of a buffer for US dollar to hold on to the gains that it has made. So maybe sort of a contrarian position which is coming up for US dollar. We don't have a forecast or a view whether dollar will appreciate or depreciate, but this single fact that currencies are not priced in what we do, but priced according to what our trade partners are doing. In case of United States, most trade partners have fiscal position or even trade positions which are worse than United States, and therefore the ability of the dollar to, for now, continue its strong position appears to be likely. This was the first section, and maybe let me, put an end to this section by showing you what US economy has done. And you can see there are two lines. The orange line is the US stock market, while the black line is the economic regime index, which has started to weaken. In the past, we've seen whenever US economy weakens, stocks follow, or possibly they go hand in hand. Last four slides, we clearly told you that there is an early signal where if fiscal considerations in US are reversed, which means that government expenditure is reduced, there is a possibility that economy also slows down in US, and that can have ramification for stocks. So section one tells you two very clear ideas. One, the epicenter of global growth or its reversal resides in US fiscal math. If there is a reversal or slowdown, there is a likelihood that it will have impact on global growth. Have we reached that tipping point where they need to slow down on their borrowing? Data tells us we have. And therefore, in the next 1 or 2 months, 45 to 60 days, these are important considerations to note. And eventually, these data points, when they come out, will have important ramifications for markets, not only US markets, but also from a global perspective. The section two is an attempt to answer a very, very critical question, which is why has India outperformed in the past? And why we wrote this section is that when we talk about India, we see a very splendid 25-year, 30-year performance. In last 30 years, our CAGR returns have been more than 10%. In last 25 years, close to 12%. And recent returns are, significantly higher, between 14 to 20%, depending on what part of markets do you watch. And when we think about India's outperformance, usually the first port of call or first simplistic explanation that is given is the GDP growth. That means that India is the fastest growing economy in the world, and therefore equity markets are performing. In the past versions of DSP Netra, we have highlighted how it is a spurious correlation where only only economic growth does not translate into equity returns. And there are enough global examples where even after a very strong economic outcome, equity markets have not performed, or without economic growth or very low economic growth has seen equity markets do extremely well. And therefore, we thought that we should write a section showcasing how growth and other narratives that we hear often are only at best supporting factors. They are not the drivers of equity return. And therefore, we culled out data, and you can see the data on your screen. We looked at many countries. We put about five here together, and you can see that in many countries, the return on equity, when you watch it from that parameter, which is a reflection of shareholder returns, you can see United States leads at 39% of its companies, creating a 20% plus ROE over a 20-year period, or a 10-year, last 10-year average. Even a 20-year average will be closer to this number. India stands at number two, where 34% of the companies, or at least one third of our universe, has about 20% plus ROEs consistently over the last 10 years. And most other emerging markets struggle to reach this number. What does this mean? That a large set of companies in India give very higher shareholder returns. And each country has a different cost of capital. For example, in China, the 10-year yield is close to 2%, even lower than United States. So in that country, to make a 20% ROE is going to be very, very hard because competition will come in very, very fast. Similar is the case with many other countries. So every country in local currency term has a different cost of capital. If you adjust ROE for cost of capital, which is the lower panel on your screen, which is the blue bars that you see, emerging market as a whole has actually detracted shareholder returns, which means that it has made shareholders lose money, while India still stands at number two in delivering very high ROEs consistently, adjusted for cost of capital. And United States continues to be the number one undisputed leader, and largely because of the very strong technology sector that we've seen in US, which is a major contributor to very high ROEs in United States. Now, what is the conclusion from this slide? One of the chief reasons for India to outperform is ROE. So one question that all of us should ask ourselves, what is the key driver of equity returns? Or what causes equity shares to outperform a simple bond or a GSEC security? For example, the 10-year India GSEC bond trades at between 6.8 to 7%. What could be the reason for an equity share to outperform this return of 6.8 to 7%? So most, simplistic definitions tell you that because we are a growing country, because we have XYZ and some FI flow or SIP book, etc., those explanations might come in handy. But the real answer is very, very straightforward. Any business which can earn a return over its weighted average cost of capital, for example, in this case, let's say the risk-free rate, which we can take at about 6.8 to 7% of GSEC. If any company is able to earn a return higher than that number, eventually its share or its equity share in that business will probably earn a return higher for the shareholder. That is the most simplistic definition. It does not cover any growth, any other parameters. At best, all those parameters are supportive in nature. And when you look at this definition from a pure bottom-up perspective, India has a lot of businesses which do that. And maybe the next question could be why? And the answer is that Indian managerial and entrepreneurial talent has been able to withstand lot of cycles and still deliver returns. And there are other important implications and reasons for doing this. For doing this, maybe we'll discuss those reasons in the subsequent issues of DSP Netra. But maybe small trailer of that is that a lot of Indian businesses have they pay lower employee cost and also probably use raw materials which are cheaper. This causes a large deviation in gross margins and also eventually causes higher return on equity with less dilution. And these are some of the reasons why India has outperformed, delivered strong returns on equity market. Another similar reflection of consistency comes from this data. So we looked at companies over the last 20 years. We can go back with more data and look at even longer term data. The results will not change. Look at the lower table here on your screen. It is Nifty 500 companies. And you can look at companies where the change in book value over the last 20 years is positive. So there are 309 companies where over the last 20 years the book value has grown. And 49 companies have actually grown their book value every single year. Now, this is a fabulous stat. Very few countries will have companies where shareholder value grows every year. Book values maybe is one parameter to look at. A better parameter to look at is intrinsic value, which is very hard to calculate. And it is a subjective number. So therefore, taking an accounting entry of book value gives us some indication, but it still tells you that two-third or more, because there are a number of companies which have got merged or delisted, at least 2 in 3 companies in India deliver a growth in book value over time. You will not be able to find this stat for many other countries, maybe excluding in the United States. These numbers will be far lower for most other countries when it comes to the number of companies. This tells you that consistently Indian businesses have delivered over a very long period of time. And this probably is a superior outcome, as the slide title says that poor managements produce poor market prices and superior management produce superlative market prices. And the outcome, which is superlative market prices in India, that is available to you to see, has to be linked to superior management and not to the market narratives that we often hear about FIIs or DIs or SIP books or GDP growth or multiple other equations. Those may be enablers, those may be background noises, maybe detractors, but the single important factor is entrepreneurs able to deliver high shareholder return. The third is the complexion of how Indian business leaders have performed versus global leaders. And we looked at data from about 14 sectors. And you will see that we picked an Indian leader in that particular sector and a global leading company in that particular sector. And you will find that 10 out of 14 sectors, Indian leaders had a higher return on equity than global leaders. And similarly, on 12 out of 14 sectors, Indian leaders delivered a higher EPS growth over a 20-year period versus the global leader. Now, this is a fabulous outcome. It tells you that not only consistently Indian companies have delivered, even the market leaders in India are better suited or better placed than global leaders in the same category. Now, this tells you the probability that Indian leader delivers a higher return is much higher, and this is what the data tells you. Uh, One very important rider or disclaimer, so to speak, all these data points are back-ended or historical. They do not tell you that whether in the next 20 years we will repeat what we've done in the last 20 years. And there is no way to even know or forecast whether this will repeat or not. One guesstimate that we can make, or probably look at some facts and arrive at whether this can happen again or not, is what has enabled this to happen. Of course, the number one top reason is the managerial talent that India has, and maybe the other enablers, which are often discussed as the most important and the only reason for India's performance, which is probably GDP growth. India has shown more consistent growth. You can see this chart on your screen. India's growth has been fairly consistent between 4 to 6%, but the volatility of growth, which means that the variation in growth has also been lower than rest of the world. Now, this creates a enabling environment or probably more gives the businesses better visibility on how they're going to operate, in which environment they're going to operate, and which maybe acts as an enabler for businesses to do well. There are other enablers which has helped Indian businesses do well, maybe a stable policy environment. In some cases, we had our own cycles. And of course, better macro financial stability. That also helps businesses to do well. But on the whole, I think all these other factors have been quite volatile in India. But still, businesses have delivered very high ROE. So to end this section and talk about the next section, just to wrap up, we believe that the sole and the most important reason for India to have done well and probably to do well in the future is very high shareholder returns from a wide variety of businesses in India, which is somehow absent in most other countries, barring one or two others. The third section is early signals. In this section, we'll talk about some mixed signals from various places. The first is FI selling. And foreign investors selling has been a hot topic. In the last few months, we saw very large sell figures from FIs. It became a hot topic. And a lot of people discussed how that is causing volatility. But eventually, you saw that equity markets did not move. The corrections or small fall that we saw was short-lived. And we haven't really seen any major corrections in the market, which tells you, unlike the theory that if domestic investors continue to buy, the market should go up. One thing was clearly proven that, maybe not proven, but at least highlighted to some extent that uh, any institutional or retail selling or buying does not lead to returns going up or down. They can maybe cause a few days of volatility, but flows can never be the reason of creating or reducing returns. It is always the earnings of the underlying businesses that are resultant, that result in long-term equity returns. Um, Flows and other factors can only be short-term deviations and probably nuisance, but eventually they fall in line with how earnings are happening. Now, one of the most important factors, and maybe if you go back to our earlier edition of Netra, we wrote how foreign investment flows are a bigger driver of India's balance of payment than of equity markets. And the last version of Netra detailed this. You can go and refer back to it. In this slide, we are showing you how, although people or investment community at large are focused on FIs, we've seen a trend where foreign direct investors, which is a more sticky form of investment, have also become net sellers. In fact, in the last 12 months, from September 24 to September 25, FIs became FDI selling happened in 2 quarters. And we haven't seen this number so close earlier. There was one selling during the COVID era from FIs for a quarter, and data going back to 2005 also shows you one more sell quarter. But we haven't seen FDIs selling here. And one of the reasons could be the high valuations that Indian markets offer at large, where these foreign investors are not able to get similar valuations elsewhere, which is causing many of them to exit maybe part of their businesses at lofty valuations and move out. And this is not happening only in FIs. That means the market that we watch every day or the flow data that we watch on a daily basis. This is actually happening in the background as well, which is FDI. And we believe that this is a bigger nuisance or bigger source of risk than FI numbers that are discussed on a daily basis, because FDI is a more sticky, more meaningful, larger share of India's flow. For example, annually we get FDI flows between 30 to $50 billion, depending on which year we are talking about. And negative FDI number takes away a large chunk of annual flows from India. And this is probably another reason why you saw an FCR announcement from the central banker very, very recently. And this tells you that foreign capital probably is finding valuations very attractive to sell, not to buy. And this becomes a important factor in assessing how large investors who are holding equities, which means FDI investors who are holding businesses, not as trading investors, but as investors in the truest sense, are also finding it appealing to exit part of their stakes at the lofty valuations that India offers. The second is, large cap stocks. You can see once again the broader market, and when you compare it to large caps, um, very significant data point reached here, where large caps are now at their lowest share in terms of the overall market capitalization. Nifty 50 at 44% of total India market capitalization, and top 10 stocks at about 21% of total India market capitalization, available to you at much lower aggregate market cap versus the rest of the market. In hindsight, these readings appear very, very logical and easy to spot, but in real time, it is a real heartburn to see whether this will reverse or not, or how much time will it take to reverse or not. Whether these stocks, which are large cap or top 10 stocks, will eventually outperform the rest of the market is a mystery. But you've seen that historically, these are the data points which eventually tell you that a contrarian signal is reached, or possibly you've already reached an extremity. And this is one such extremity where the share of large caps, which contribute 70 to 75% to profits eventually, and have much superior ROEs. The top 10 stocks run a ROE picture of about 22%. Still continue to have a much lower market share, largely because the rest of the market trades at a much lofty premium. The next is the mix of high valuations, but also slowing corporate profitability. You can see that top line growth, which is sales growth, has now hit single digit. For over the last 6 quarters, we are doing about 6 to 8% top line growth, or sales growth. Not a very healthy number. Margins have started to peak and started to come down. You can see that most corporates are now have exhausted all their resources where margins would have gone up, and even PAT growth has started to fall. Now, at a wider universe, if you trade at between 24 to 30 times, given whichever market cap we look at, if PAT growth is low single digit or high single digit, continuing a very high price to earnings multiple of 20 to 30, 24 to 30 times is going to be a challenge. And therefore, there is a good likelihood that we see a PE derating or valuations derating for the broader market, specifically where valuations are very, very high. And this represents a risk for expensive stocks and also gives you a signal of caution for broader market. The next is again, significant money raising which has happened. You can see these black bars that you see. There are some years that we've highlighted here. For example, in financial year 25 YTD, we've seen about 1.5 lakh crores of fundraising through IPO, FPO, and OFS. If you adjust for inflation, this number is ahead of the fundraising that happened in FY18. And FY19 was not very kind for the market. We had strong decline years. And historically also, whenever high fundraising has happened, where promoters have cashed in and sold a lot of equity, in the next and the subsequent years, market has seen large drawdowns. Now, this does not mean that we have seen a year-on-year decline. That is also the case, but what we have seen is that from peak to trough, the market sees a larger drawdown in the year or subsequent year, which is more than average drawdown of 23% that we've seen historically. So we need to be very careful with the market drawdowns going ahead. And the fundraising data is again one more indication that these fundraising has reached an extremity, causing you to place some contrarian indications from this. The last insight is from the silver market. Silver has been a underperforming precious metal, underperforming gold in the last 3 to 6 months. Although on a year basis, the performance is neck and neck. But when you look at data for demand and supply, this will be the fourth year where silver demand will outstrip its supply and creating a deficit. And you already know that we are seeing a gold bullion bull market. Although other precious metals have not participated as of yet, platinum and palladium continues to be sideways, but silver appears to be attractively priced. 3 issues ago in DSP Netra, we showed you how to value gold and silver. Based on that and based on how the silver market is progressing with year-on-year consecutive deficits in demand and supply picture, we believe that silver represents a good opportunity for investors to have them as a part of their asset allocation strategy. Silver is a very volatile commodity, therefore, it cannot be in very high weightages in portfolio, but based on your risk appetite, appropriate exposure through asset allocation could be meaningful. The last slide is on power of compounding, and we speak about this story where a king presents an offer to an inventor for any reward, and the inventor asks for doubling of 1 grain of rice on a chessboard on every single check. And you can see that 1 grain of rice eventually turns out to be 9.2 quintillion, which is more than the rice which has ever been grown today. And this is the power of compounding, that slowly and surely it grows to mind-boggling proportions. But if you note very carefully in this whole story, um, the doubling is never, broken, or it does not suffer any negative year or negative box where it doesn't go down. So one of the most important principles of compounding is that A, you have to stay for a very, very long period of time, and B, you have to be conservative such that your compounding is not disturbed by large negative fluctuations. And I think that causes compounding to really become the wonder of the world. And this is what this slide shows. So just to sum up, we discussed three sections where we said that US debt situation could be one of the most important drivers to watch based on a possible U-turn in how US manages its fiscal deficit. Second, we spoke about why India outperforms, largely because of the managerial talent delivering high ROEs versus all the stories that we hear all the time. And third, we discussed early signals where selling from foreign direct investors has become a important number to watch, uh, also for the currency market, so to speak. And also we noted how large caps have become distorted in terms of their share of market cap, and this could be a very large opportunity. And plus, we discussed slowing earnings growth and high valuations contributing to riskiness, and also the fundraising spree that we have seen in FY25, signaling that there is too much easy money flowing, and it is a source of caution. And the last, we discussed the silver market imbalance where demand is outstripping supply. So I will stop here.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.